All right, let's talk about a really important tax rule that every single investor has got to know. It's called the wash sale rule. And trust me, it's one of those things that can easily trip you up if you're not paying close attention.
So let me ask you a quick question. Have you ever sold a stock or some other investment at a loss? Maybe to help offset some gains you had and lower your tax bill? It's a super common strategy. But what if I told you the IRS might just turn around and say, yeah, sorry, you can't actually deduct that loss? It sounds crazy, but that's exactly what can happen. And it's all because of this one little rule.
Okay, let's get right into it. This is a tax trap that catches so many investors off guard. So the big question is, what in the world is a wash sale? So here's the deal. A wash sale happens when you sell something like a stock at a loss, but then you quickly turn around and buy a substantially identical one within a very specific window of time. If you do that, the IRS basically says, hold on, and they won't let you take the tax deduction for that loss. So how does this actually get triggered? Well, a few things have to line up. First, you sell a security, and you lose money on it. But here's the key. If, within 30 days before or 30 days after that sale, you pick up a substantially identical security, you've triggered the rule. And that includes buying it, trading for it, or even getting it for your IRA.
Let's really focus on that time frame because this is where a lot of people get confused. It's not just about what you do after you sell. We've got to talk about this whole 61-day window.
Yeah, this visual really clears it up. You can see why it's a 61-day period. The IRS looks back 30 days before you sell, they look at the day you actually sell, and then they look forward 30 days after. If you buy a similar security anywhere in that entire time frame, it can trigger the wash sale rule. Now that phrase, substantially identical, that's where things can get a little fuzzy because the IRS is intentionally a bit vague. For example, selling stock in, say, Ford and buying stock in GM, that's usually not a problem. But things like convertible bonds that can turn into stock or shares of a company that just went through a merger, oh yeah, those could absolutely be considered identical. The big takeaway here is that it's not always as simple as just looking for a different ticker symbol. Okay, so you messed up and triggered the rule. Does your loss just disappear forever? Well, here's the good news. No. This is really important. The loss isn't actually gone for good. It's just postponed.
Here's how it works. That loss the IRS won't let you deduct. It just gets added to the cost basis of the new shares you bought. Think of cost basis as just the purchase price for tax purposes. So it's really just an accounting adjustment. I know this can sound a bit like tax jargon, so let's just walk through a really simple example. I promise, this will make the whole thing click.
So, imagine you buy 100 shares of some stock X for $1,000. A little while later, the price drops, and you sell them all for $750. But then you get seller's remorse. Within 30 days, you jump back in and buy another 100 shares for $800. Boom, you've officially triggered a wash sale. Your original loss on that sale was $250, right? Well, because you bought the stock back so quickly, the IRS says, nope, you cannot claim that $250 loss on your taxes this year. So instead, that disallowed loss gets carried over. And you do it with this super simple formula. You just take what you paid for the new stock and you add the disallowed loss to it. So let's plug in the numbers. You take the $800 you paid for the new shares and you add that $250 disallowed loss. Your new cost basis is now $1,050. This means when you eventually sell these new shares, your taxable gain will be smaller, or your loss will be bigger because your starting cost was higher. See? The loss isn't gone. It's just baked into the new price. Of course, because we're talking about taxes, there are always a few more twists and turns. So let's quickly cover a few other situations and the main exception you should know about.
So this rule isn't just for buying and selling plain old shares. It also applies to things like options and warrants. It applies to short sales. And get this, if you sell for a loss, but then your spouse or even a corporation you control buys that same security back, that's also considered a wash sale. The IRS thinks of everything.
Now, the main group of people who get a pass on this are professional securities dealers. If taking losses and jumping back into positions is just part of their normal everyday business, they're generally exempt. For the rest of us, though, we've got to follow the rule.
So you might be wondering, how do I even know if this happened to me? That's a great question. When you get your tax form 1099-B from your broker, take a look at box 1G. That's usually where a disallowed wash sale loss will be reported. Your broker might catch it for you, but it's always smart to double check.
And that really brings us to the final question you should ask yourself.
Now that you know what to look for, that 61-day window, the whole substantially identical idea, and how the loss is handled, it's probably worth taking a look. Is there a hidden wash sale quietly affecting your portfolio's tax picture?